Larry Schober is joining us, the CIO of Efficient Advisors. So we're back at the top of the range we've been in. Larry, was this about some decent economic data this morning? Is it just the trend continuing? Is there anything that can stop this?
I think the answer is yes to all of it. Also, you have to consider the Fed has put a natural cap on things, at least a natural cap on rates. When it comes to dollar, it's really just relative. And you're right, 52-week highs against the euro, the dollar index rubbing up against, like you said, 22-month highs, but it's relative to everything else. And so when you see the scheme of things, you see a natural cap in rates brought on by the Fed with a new easy money policy, or at least not raising rates until they see durable inflation or until they see a lessening of the negative risk premium that surrounds us right now.
Yeah, I think that's a great point, Larry. I think it goes hand in hand with the way we've kind of described it in terms of the backdrop for stocks too, right? Because as long as that dollar's been up there since the spring of 2018, any move higher in yields gets knocked right back down because basically we're the only house on the block. I mean, is that the logic you see as well?
Well, it's really an irony more than logic. It's like stocks are rubbing up against highs that we saw back, in October, at the expense of 44 basis points in two-year treasuries, 52 basis points in the 10s, and what seems to be an eternal inversion in the 2-5 yield curve. So it seems like the whole game is rigged right now. The trading atmosphere is rigged. And it's really just a cap put on by the Fed that's causing all this to happen right now. I heard Tom earlier say he's not really sure why stocks are up here, and no one knows why stocks are up here except the fact that the Fed has made money easier to go by, and people are just going along the curve and putting risk on.
Yeah. Well, here, I'll play the other side of it then, Larry, because even with the rally back, our valuations are lower than they were at the previous high. They're lower than they were in the high before that. We're at about 17. So, we're a little bit above the average. Yep. But should those be lower when we've still got this rush of money that's just compressing all these yields? I mean, if our data were miserable, then I think that would be a strong case where we go, look, this yield curve is about to invert again because the numbers stink here. But they're not that bad. I mean, they're still just kind of decent.
No, not bad at all. And with regards to the stock market, I mean, I think the bulls are arguing for a 17 times multiple. And if that's the case, if 2020 earnings per share really does move from 181 to 183, then a 3100 SPX makes a lot of sense. But right now it seems to be a 16 times multiple, which brings us to 2930, even with earnings per share going up a couple dollars. And I really can't see it going up more than that, given the data and the earnings that surround us.
Yeah. All right. And just to correct myself there, the 4P right now is about 17, a little bit above it. Trailing is getting pretty lofty again at about 19. But hey, we were at 22. We were at 23 in the high of January 2018. So, hey, Larry, let's talk about what's happening here for bonds, all right? Because they've kind of slipped to the back of this conversation in a way. I know you focus on bonds, so maybe not for you, but that's why I'm coming to you, because it's like the higher, the slow yield climb from December doesn't matter to equities. Been shrugging it off. And the whole story here just seems very comfortable, basically, between kind of the 2.5, 2.6.5. Has the excitement of bond volatility gone away?
It hasn't gone away. I mean, it's gone to nowhere because you figure, other than the Fed putting a natural cap on things, 30 years near 3%, 10 years at near 260, that's a very attractive buy globally. And so with that in mind, you see a lot of bottom fishing when we get up to these levels. It's really hard to make a case for rates going much higher than that. Obviously, if we get a blowout GDP number on Friday, the whole, everything changes. But if it stays within consensus range, it's an attractive buy. And so it really has pushed volatility way down. And you're right, the story isn't bonds right now, other than the 210 curve, which is bumping up against, cycle highs at 20.5 right now. 22 is the high. But other than that, I think we'll have to wait to GDP. That could be a game changer, but if it comes within consensus, it's just going to be the same old, same old.
All right, now that's a great point to segue into the last question, Larry, because the U.S. economic data here still surprising to the negative overall when you look at the city economic surprise. We've had some better numbers, and I think some crucial areas like housing and some relief to the retail print from last, 2018, last quarter in 2018. But other than that, we're still negative territory. What's not is the China situation. We've now had 2 months of really solid surprises to the upside. Do you think that this has been adequately either discussed or priced into, yields or priced into a turnaround story at all? It seems like this is going largely kind of innocuously in terms of market effect.
Yeah, I think it was only adequately discussed between the two of us a few months ago.
I'll take it.
Just imagine if China inflects higher and remains higher, what that's going to do to risk assets. Dumb luck. I mean, it's not like I traded that way, but I said just imagine that because the bar was so low. And yeah, you're right. Their numbers have been stable. They put some stimulus in place, which had about a 6-month lag. And the same is true here. I mean, we're starting to see the fruits of what the Fed did or did not do. And we saw that today with the home numbers that came out. And I think we'll continue to see that. So that's going to help carry the day. But to get much past where we are right now, it's going to take a lot of, hard mining with regards to getting numbers better in Europe. And I think we're a ways off from that.